Welcome to another edition of Perspective. My name's Rob Pizzichetta, founder of Mont Wealth, and today we have Phil Strano, Head of Credit Research, Yarra Capital Management. Welcome back, Phil.
Lovely as always to speak to you, Rob. Thank you.
Thank you. No, pleasure. Great catching up with you. But today we're going to touch on three key things. We're going to look at the Australian economy and interest rates. We're going to talk about the global macro and economic outlook. And then finally, we're going to come back and talk about your portfolio and how you can deliver returns for investors. But before we get started, the general advice disclaimer: anything we discuss today is general advice only. Anyone acting on that advice without written and agreed consent from a financial advisor, someone like myself, does so entirely at their own risk. So Phil, let's get straight into it. The Australian economy. What's the outlook for interest rates? What's some of the indicators we're looking at?
Yeah, thanks, Rob. So in terms of the Australian economy, we do think that obviously growth is going to remain pretty anemic now for the rest of the year. So we don't believe there's a recession, but it's not going to feel all that great. And that's a consequence of effectively the rate increases that we've seen, a bit of the currency appreciation that we've had, and that is likely to filter through into higher unemployment over the rest of the year, which will basically mean that plus inflation actually coming in a little bit below expectations will give the RBA a chance to reset their settings around interest rates.
Great. You said that it feels like a recession. You're saying we're not going to get a technical recession. What are the key drivers that will force to ensure that we don't hit a technical recession?
At the end of the day, Rob, immigration has basically stopped us from having a recession probably for 3 of the last 4 years, really. Having immigration at the levels we've currently got will most likely ensure that we won't have a recession, but that's probably not going to stop us from having a per capita recession again.
We did have a per capita, technically a negative return in the last GDP update.
Yeah.
To your point, it's actually happening. And I think the last quarter we saw private investment increased in the last quarter GDP number. But a lot of that was on the back of data center builds. How sustainable is that?
There's a lot of data centers being built, Rob.
Yeah.
And it is amazing how much those things cost. Just mind-blowing. But there's tens of billions. If you look at NextDC or CDC, AirTrunk, and I'm sure a few others, we're talking 20, 30 bill spends across each of those, varying between them, but overall adding up to 100 bill plus in terms of data center builds. It is quite significant.
And you also touched on unemployment likely to rise. What's the house view on where unemployment settles? I know the RBA had predicted unemployment at 4.5% by the end of this calendar year. It touched that most recently. So what's the view from the house?
Yeah, we think we'll move towards 5% over the course of this year, where we end up landing. And there's obviously a bit of conjecture and uncertainty around that. But depending on the transmission mechanism around confidence, business and consumer confidence, and how low it is at the moment, how that actually ends up translating into unemployment. Bit of uncertainty around that, but you could, based on correlations, theoretically think that it goes to 5, even 5.5. But let's wait and see. But overall, the trend in unemployment is actually up.
Yeah. And do you think, though, that the Australian economy needs to have unemployment at 5 to 5.5% and the semi-slowdown or recession to get on top of inflation? Or do you think we need to muddle through and it will sort itself out?
I think our view has been that a lot of the inflation that we were seeing when the RBA initially started hiking rates was predicated off things that they either couldn't control or effectively were stuff that was revision mirror stuff, energy rebates coming off, which its inflation was predicated 18 to 24 months before that, really. So we didn't really think that the RBA probably should have hiked rates as much as it has. So overall, we think that inflation will moderate naturally. I think generally the RBA's been really concerned about inflation expectations. Higher unemployment is actually going to mean that those inflation expectations remain a bit more anchored than what they expect.
Okay. And then just on the house view as well, where does the inflation settle? What's the new norm? Is it 2 to 3? Does it become 2.5 to 3.5%?
I think we still have it going back into the band at some stage over 2027-ish area. But yeah, obviously subject to change, how volatile these numbers can be from time to time.
Yeah, understood. So more volatile, subdued economic growth, higher unemployment, and probably a pause on interest rates for the time being, but we could start seeing some rate cuts coming through over the next 12 or so months at least.
Yeah, look, our view is that the RBA will most likely, at the very least, adopt an easing bias by the end of the year. Now, whether that means we get a rate cut in 26 and then followed by some more in 27, or they all come in 27, but overall, we think over the course of late this year and next year, we'll get 3 rate cuts. So we're not going back to sub 1%. When you think about all the demands for capital right now, they are significant, and that is likely to keep interest rates a bit higher than we were accustomed to, certainly through COVID and before COVID. And that's likely to mean yields stay a bit higher, real yields stay a bit higher.
Yeah. And so to your point, one of the issues we've got in Australia is productivity growth. We're really lacking it. But when we look externally or overseas, we can see that a lot of the other economies are flying around productivity growth. What's holding us back then?
My own personal view on this is that our productivity is not as bad as and it's certainly a house view as well, it's not as bad as what the actual figures say. At the end of the day, we've had a big expansion in the care economy, certainly around our aging cohort. We do have an aging demographic at the moment, and spending money on aged care and healthcare, which we all want, is not productive.
Yeah.
So that's not really been picked up in the figures. So if you exclude that, based on our numbers, productivity is roughly around average.
Okay, positive. All right, so on that note then, we look globally, we look to see what's going on in the rest of the world. When we look at the US, let's start there. We've got this new Fed chairman, Walsh, who came out a little bit more hawkish at his media conference the other day. What's your views on US rates and the economy there?
It's interesting. The market's now pricing in almost 1.5 rate hikes in the US now, between now and the end of the year.
So that means 32.5 basis points.
34 basis points being priced now. The rate hike's been priced into the US. And what makes that interesting is that it's been understood that the new Fed chair would not raise rates on Trump's watch. So let's wait and see. But the market is starting to think about rate hikes. Most recently, our views have been that they probably won't hike.
Yeah.
But it's sometimes in the US, given their political environment at the moment, may not be as rational as you and I should probably think.
So to your point around that they won't hike, is that because they're looking at data that's backward looking, i.e. what happened in the Middle East, and now that'll solve itself, and we're starting to see some shelter data, which is obviously housing and rent, that's coming off as well. Is that part of the reason why?
I think so. But and you marry that against the AI boom. Because when we talk about the investment that's going on in here, that's a splash in the ocean compared to what's going on over there.
Yeah.
So it is incredible, just the amount of money that's been spent.
Yeah, and the driving GDP growth as well, even though I think the Fed came out and lowered expectations of growth from 2.4 to 2.2% over the next 12 months. So it just tells you where a lot of the growth is coming from. What about when you look at Europe? How's that at the moment?
The overall themes globally are the same, right? Is that when you think about this period now, it's very different to where we were, say, pre-GFC. There were a lot of tailwinds during that period, in 2002, 2007, for instance. And now, going forward from here, as far as risk assets are concerned, the only real tailwind I can see is probably everything else is more of a headwind. Whether you look at the level of indebtedness, the fact that rates are actually a bit higher and trending higher, and you've got the aging demographics issue. That's not just an Australian issue, that's globally. And when you talk about Europe specifically, it's horrendous over there, right? As it's in Japan, for instance, they are all headwinds. And also spending money on managing geopolitical risk. That wasn't an issue 20 years ago. We just come off the Cold War. Everybody was happy to spend less on defence because there was no real issue around maintaining national security. That's not the case anymore.
Yeah.
There's just a lot of money being spent in areas that are not necessarily all that productive and that are just crowding out private investment and putting pressure on rates.
Yeah. And so to your point, you noted the AI spend in the US. We've discussed AI spend here in Australia. You've got what's going on in Europe and even Australia having to spend more money on protection, security. That's driving a demand for debt as a result of that to fund these expenses. But at the time, investors need a higher return as a result of that. So now let's talk a little bit about what you're seeing in your market and how investors can benefit from that.
Yeah, so yields are higher. And when yields are higher, it's quite attractive. Our portfolios at the moment are still average investment grade quality and generating anywhere between 6 and 7.5% yields right now. That is an incredibly attractive return or an attractive base of income. And it's also very defensive.
So you've got I think you guys call it the BBSW, which is the bank bill swap rate. So that's the floor. And then you lend out money to people that borrow it at a higher rate above that. So what's that rate above that? Is it 3 or 4% above that BBSW? Is that what works?
So the way it works is obviously we manage a portfolio of credit assets and we manage to a level of risk. Ultimately, depending on the level of risk that we take in lending to an issuer, the more risk we tend to take on a credit risk, the spread. The longer the duration in terms of we're prepared to lend to them, the higher the spread over that BBSW rate. And what we do is basically blend a portfolio to effectively get the optimal blend from our perspective of risk-adjusted returns, risk, return, and maintaining liquidity for investors. Most important.
Yeah. And now you've recently published an article. It's on your website. I'll put it in the show notes. It's worth a read. But you talk a little bit about tighter spreads in the market at the moment. What's causing the tighter spreads?
Yeah, so tighter spreads at the moment is basically being driven by the attractive outright yields. So the investor mentality is, because investment grade assets in particular, you don't necessarily have to worry about drawdowns around defaults or anything like that. So when investors are getting paid in excess of 6% on investment grade assets, they typically don't worry about the spread too much. And what you've had since the start of the year is you've had a reasonable sell-off in the risk-free rate. So the yields on government bonds have gone up. So the benchmark itself has gone up.
Yep.
The benchmark rate, which means that you need less spread to achieve your desired outright yield.
Got it.
So what that's done is basically meant that for the first time since the GFC, we've got a thematic where we've got higher than average outright yields and lower than average credit spreads. That can last, that can be quite prolonged. That can last quite a while. But at some stage, that composition of return will change. It's important for us to have levers in there, which we do, through primarily interest rate duration and maintaining interest rate duration where it makes sense to do so, to protect investors when that composition of return changes, but also then provide us with a real platform to go and invest more in those investor grade assets to take advantage of those higher spreads when they don't eventuate.
And so let's talk a little bit about what's causing that government bond yield to be a little bit elevated. This goes back to what we said before, right? The
inflation, it's sovereign balance sheets that are probably a little bit more stretched. It's also around de-dollarization theme in the US and those high yields then being translated around the world. It is multifaceted. There's no one answer really, but it's a multitude of answers, but most of it is in relation to inflation. So you've had a period of time now where basically inflation's been higher than the range, central bank ranges, and you're starting to see that the market's kind of factoring in the central bank's probably getting a little bit more serious about inflation. We've seen that here domestically. And if the Fed does follow suit, then that'll be the case as well.
Yeah. So the portfolio is generating 6 to 7.5% roughly.
So the higher, it depends which fund you're talking about. So the higher income fund has got an estimated yield at the moment, roughly about 7.3.
Okay. So you're getting 7.3 at the moment, income, highly rated exposures, which is fantastic. You said earlier though, that we think that we're going to be able to get on top of inflation, come back to the band. How does it change the portfolio allocation, the way you look at it?
Yeah, so at the moment we're running a bit of duration because we do think that bonds have been oversold and there's a good chance that those risk-free rates will come in again a bit. And we've already started to see that.
Yeah.
That's bond yields have basically been rallying for the better part of the last couple of months.
Yeah.
As the market starts factoring in, because we went through a stage where the market was factoring in another 3 rate hikes and now it's factoring in half of one. We think there's a bit more to go on there and hence why we've got a bit more duration.
Yeah. Just duration is bond yields of 10-year or 20 or 30 going.
It's basically just taking a view that the risk-free rate will rally, will come down.
Yeah.
And being able to generate return off the back of that happening.
So like a capital return and locking in the income when you're buying it.
So yeah, so it's basically an income gain.
Yeah.
Yeah.
And so you expect this to play out over the next 6 to 12 months?
Yeah, look, gradually. It's been happening for the last 2, and we think there's still more to go. There's no question about it. As basically the market keeps thinking that the RBA is done, I think the remaining kind of 15 basis points that's in the curve will basically come out. And then if the economy basically slows to the extent that it does and unemployment starts going up a bit more, there's a good chance that the market will start pricing in some rate cuts for next year.
So in effect, you're protecting investors just in case there is an economic shock or slowdown.
Absolutely.
Yep. And so as a result of that, you're playing the risk-adjusted return by looking at duration, which expects the RBA and other central banks eventually have to cut rates. So the investor will be protected as a result of that.
Well, if you look back to April 2025, it's a very similar thematic to what happened back then. You had a situation where outright yields remained pretty constant through that month. Now, if you go back that month, we had probably the last meaningful risk off before everyone discovered the term TARCO. And effectively during that month, you had outright yields basically remained constant, but you had bond yields rally significantly and credit spreads basically rebased higher to basically the exact same amount to what bond yields rallied. So hence why you have a bit of duration when you think that there's a thematic that can repeat, and it makes sense to do. It provides that additional layer of defense, which in addition with the amount of income that we're generating in a portfolio right now, means that it's really improbable for investors to actually suffer a negative return over a 12-month period. You may get one over a month, but over a 12-month period is very hard because you're generating roughly about 60 basis points of income starting point every single month.
To give investors an understanding of the volatility or that lack thereof, how did March perform for the fund?
Yeah, so our two kind of weather credit funds, the enhanced income fund was down about 1%, and the higher income fund was down about 60 basis points.
Has it recovered all of that since?
Oh, absolutely. Yeah. So in terms of the higher income, we've done roughly about 80 basis points over April and May, and looking really strong month to date this month as well.
On the back of that duration call?
Yeah, the duration, but also, like I said, the income. Yeah, like I said, the starting point, 60 basis points a month.
Yeah, okay.
And then the duration right now is being additive to that.
Yeah, and what other exposures have you got in the portfolio that you'd like to communicate to investors?
So we've got the beauty of certainly the higher income fund, which is my baby, portfolio manager on that. It's a proud multi-sector Australian credit fund. So it plays across everything to do with Australian credit. It mixes what we think is an appropriate exposures across everything, focused on risk-adjusted returns. So what in a fund like that is that we have an appropriate amount of private credit based exclusively around the ABS and mortgage warehouse space. We play a little bit in the syndicated loan space as well. And then we play across all the public assets, including ABS, and bonds, FRNs, subordinated debt. And what's really important is that we are always laser focused on risk-adjusted returns, understanding the risk, and then making sure we're getting paid for that risk.
And just on the focus on risk, what are some of the risks you're seeing in the Australian exposures to credit at the moment?
So overall, when you think about investment grade, it's not really a drawdown issue. There are things that are not priced correctly, and we say no to those deals. So we don't participate from a relative value perspective, but there's no real drawdown risk in investment grade. So there's anything to worry about there. That very rarely is, because if you look at IG default rates around the world, and they're basically non-existent. So it really is about that composition of return and how you play the bond yields versus government bond yield versus the spread. And that is our focus in relation to investment grade. Now, in relation to the high yield components of the portfolio, different story. Once again, given our flexibility and given the fact that we are so diversified, it gives us a real ability to be really discerning. So in other words, be really as much diversified as you can be in that space. Focus on uncorrelated idiosyncratic risk profiles and making sure that you can say no and cherry pick the best assets and then size them appropriately. So if you've got high yield issuers that are uncorrelated to each other and they're sized at about 1 or 1.5% of AUM, even if you have one that doesn't perform well, and typically you get one every decade or so that doesn't perform well, then the running yield smothers that out, and it's not really a big deal. But overall, in terms of the segment, it's incredibly additive to running yield.
Yeah. And so for the investors listening, did you say earlier, running yield 7.3% on your portfolio?
7.3% estimated at the moment for the next 12 months,
That's fantastic. Now, Phil, for those that want to learn a little bit more, where can they get information from you?
.com.
Right. I'll add that in the show notes. Phil Strano, thanks so much for your time. Looking forward to catching up again in another 6 months.
Rob, always appreciate your interest and thank you for the opportunity.
Pleasure.